Hey guys, welcome back. Well, let's start this video with the massive logical contradiction that we saw in the marketplace today. You know, in last night's video, based on what we were seeing in the after hours, I was expecting to see a gap up with the memory sector today. I thought the memory titans would have a strong day, and it just did not pan out that way. In fact, we were looking at the semiconductor market last night, and it appeared that it was in a full celebration mode, and we were going to have a recovery, a few strong days that led us off into the weekend with green candles. But it didn't happen, as I mentioned. What surprised me the most is that we saw ASML, they dropped a blockbuster Q2 earnings report onto the street. They beat expectations, and they aggressively raised their 2026 revenue guidance. I thought this was going to be a massive signal for the memory sector today, because on paper, the message was clear from the world's most critical, important equipment maker. They basically told us today with their earnings report that the artificial intelligence infrastructure build out is accelerating. Yet 24 hours later, the very memory and storage companies supplying that exact build out just got absolutely crushed in the market. Micron slid, SanDisk plummeted today. In a rational market, that shouldn't happen. You don't get record demand for manufacturing equipment alongside a sell-off in the companies buying that equipment. The only way that happens is if Wall Street suddenly became worried about something much bigger. If you've been following this channel, you know that the bloodbath today probably triggered some anxiety, some worry, some panic across our community, across investors in this sector overall. You're probably looking at the red in your screen or the red on your portfolio and wondering if the easy money in the memory sector is officially gone. Did I buy these companies at the top? And I want to give you the hard truth right away at the top of this video. Yes, I do believe that the easy, speculative, double your money gains that we saw in the early half of this year are likely behind us at this point. We are transitioning from a speculative momentum phase into a valuation defensive phase. These stocks, though, are not in a bubble. These are fundamentally different companies than they were in past cycles. So what happened today? Today's sell-off was not the market declaring that scarcity is over. In my opinion, it was the market beginning to price the possibility that a scarcity eventually ends. We're going to take a look at some stories, some narratives today that prove that point, in my opinion, exactly. We're going to take a look at the tape and just see how the memory sector performed today overall. I want to dive in today's video just to show you how institutional investors are probably reading the trading tape overall and what it means for us moving forward. Before we get started, though, make sure you hit like, make sure you subscribe to the channel. Guys, we are growing significantly. Let's keep this community growing. Let's see if we can get up over 38,000 subscribers with this video tonight. I appreciate your support. I appreciate your engagement. Let's continue to grow together. Let's continue to learn together as well. So if you haven't done it already, if you find value in these videos, make sure you hit subscribe. Let's start off with the first signal that came out today that I think drove some of the pricing action first overall. But first, actually, let's take a look at what we saw today in the market. As I pull up on your screen, you can see the NASDAQ 100. I want to start here because clearly you can see there was a shift of capital across the NASDAQ 100. When you look at the board, you see the memory sector, you see the picks and the shovels, you see many of the hardware companies, we had just down days today. Capital was rotating out of them. Surprisingly, it was rotating back into the Mag 7, back into the hyperscalers. We saw strong performance with Apple, Amazon, Google, Meta, Microsoft. Micron down by 8%. SanDisk down by 8% as well. Seagate over almost 6% down. Western Digital close to 9% down. Significant pressure on the memory sector today. If you look at Micron, where it finished at 904.28, down 8%. In the after hours right now, down about another 0.5%, about $4, but it's dipping below the $900 mark. If I jump over to SanDisk, you can see SanDisk was down by 8% today as well. Dropped by almost $143 a share, down to $16.15. Another $31 roughly in the after hours right now, pushing that stock down to $15.84. We know where the fair market value, we know where the average analyst price targets are for these stocks, significantly below them. Are they undervalued right now in the market? Are they a premium entry point? Let's go through some of the articles today, and then we'll come back at the end of the video and make that decision. But one of the things I wanted to cover overall was one of the biggest stories, and I think as an institutional investor, this is how they would look at it. I think institutional investors started asking this question based on what we're seeing with CoreWeave right now. They're asking the question, if demand is so high, why are the largest buyers in the world suddenly buying insurance against the price crash? And that's exactly what we saw with CoreWeave. Let me pull that up. I'm going to walk through this article together. You can see here in Yahoo Finance, CoreWeave weighs hedging its bet on memory chip prices. I think this just caused a bit of panic with institutional investors. It caused a bit of a sell-off, profit-taking that we saw with the memory companies because they're concerned that we're going to have a supply glut in the market based on this potential story from CoreWeave. This isn't a guaranteed. It's just that sources are reporting this is a path that they may try to explore. Well, we'll walk through it. You can see CoreWeave is reportedly exploring financial derivatives to hedge against a future drop in memory and storage chip prices. We know that CoreWeave was one of the major hyperscalers that signed long-term supply agreements with companies like Micron and SanDisk to lock in scarce memory. Many of those contracts, they set price floors, which protect the suppliers, but leaves CoreWeave paying an above market rates if chip prices fall at some point or dive down later. We know these contracts are out through 2030 in many cases. They're 3 to 5 year contracts. So giving a lot of revenue visibility to the manufacturers, but leaving some of the hyperscalers at risk if we see more supply come into the market and the prices drop down. So because of that, we're seeing executives now have discussed using instruments including put options, which would act like insurance by gaining value as the underlying asset falls to offset a decline in the memory chip stocks. The discussions are early, and CoreWeave has not executed any hedges. But when you see stories like this, it definitely drives concern with the institutional investors in the market. As I mentioned, they have signed these contracts to guarantee the chips during these massive supply shortages that we're seeing right now in the market. But to get those guaranteed chips, CoreWeave had to agree to these price floors. That means if the market price of memory drops in the next year, in the next 24 months, CoreWeave is still legally locked into paying those premium elevated contract prices. So CoreWeave is now looking to spend real money to hedge against memory prices. And investors hear that CoreWeave is buying puts, it causes immediate panic in the board. It causes them to hit the sell button for the memory stocks overall. But this is the fundamental misunderstanding, in my opinion, of corporate risk management. Think of it this way. Every major airline hedges against jet fuel. That doesn't mean they expect people to stop flying. It means they are managing risk in a highly volatile input cost. CoreWeave isn't hedging because current AI demand is weak. They are hedging because they understand that the cyclicality of the chip market, and they know that eventually massive new manufacturing capacity will come online. This doesn't mean that memory is peaking tomorrow. It means that Wall Street has stopped asking how high can prices go, and they started asking, when do prices stop going up? So CoreWeave is hedging because they expect a massive supply wave. Where's that supply coming from? That brings us to our second piece of evidence, China. Let me pull up this story that came out of DigiTimes today. You can see CXMT PO signals China's accelerating challenge to global memory leaders. We'll walk through some of the specifics of this story, but CMXT's Shanghai debut could reshape global memory markets by speeding China's push into advanced DRAM and HBM. CXMT is set to list on Shanghai Star Board, which is very similar to our NASDAQ here, on July 16th, raising roughly $8.5 billion US dollars in one of China's largest technology offerings this year. The company's IPO values it roughly at $80 billion, and it's a steep discount to pure play rivals like SK Hynix and Micron, who have recently traded at far higher valuations. This is currently today, CXMT holds about 9% of the global DRAM market by bit shipments. And according to Counterpoint Research, that share is expected to rise to around 11% by 2028. But here's some of the interesting pieces out of here. CXMT said that the IPO proceeds will fund next generation G5 process development, HBM3 memory work, and new manufacturing capacity. The firm expects CXMT to double capacity by 2030 and triple it by 2035, while shifting more of its mix to LPDDR5 and DDR5 products for PC and servers. Now, ultimately, at the end here, it's the company's long-term success will likely hinge on whether it can deliver HBM3 at scale, win non-Chinese customers, and maintain access to equipment despite trade tensions. If you look down at what DigiTimes put out here for what their estimate is in 2025, you can see we go from 2028, 2025, Samsung with 36%, SK Hynix 29%, Micron 24%, and CXMT with 8%. Their estimate in 2028 is you see CXMT jumps to 11%, Micron falls by 1 percentage point, SK Hynix stays the same, and essentially Samsung loses 2 percentage point. That's how they see it currently right now. That's kind of the big fear in the market, or how institutional investors are reading where the supply will come. We know that CXMT is already the world's 4th largest DRAM maker, and their prospectus tells us exactly what they plan to do with that $4.3 billion cash infusion. They want to aggressively upgrade their production line and scale up manufacturing technologies. Now, CXMT isn't going to materially change global supply overnight, but memory is historically a brutal, cyclical industry where the pillar of margins is overcapacity. And when institutional desks see a massive state-backed competitor getting handed a multi-billion-dollar war chest specifically to build out memory capacity, they don't look at next quarter's earnings. They look 2 years down the road, and they see physical walls of scarcity beginning to show the first signs of hairline cracks overall. Now let's look at the climax of this story, because this is where the puzzle piece is completely locked together. And I want to go back to ASML on this. I'll pull up a story that I saw on Tom's Hardware and paint it all together, because yesterday the market cheered ASML's spectacular earnings beat. But if you dig into the actual structural details of the report, you discover the third final piece of evidence that ASML confirmed that major foundries have officially begun high-volume manufacturing of next-generation chips using their ultra-advanced high-NA EUV technology. On top of that, ASML is executing plans to scale their low-NA EUV capacity by an extra 30% heading into 2027. You can see on the report here that Intel is the first customer, the first major foundry that is going to scale up the high-NA EUV technology to build their next generation chips. And here's the fundamental paradox of this semiconductor equipment. More advanced, hyper-efficient lithography machines mean that chip makers can print advanced memory faster, with significantly higher yields using far fewer silicon wafers. Great news for ASML's order book is eventually tougher news for memory pricing. If you look at the board today, we saw 3 major stories. CoreWeave is exploring derivatives to protect themselves from future price collapse. CXMT is raising almost $4.5 billion to scale up and upgrade memory factories. And ASML is shipping the hyper-efficient machines that will allow everyone to print memory at unprecedented yields. 3 completely different companies operating in completely different parts of the globe, all pointing towards the same conclusion. The market isn't reacting to a drop in current demand. It's reacting to the fact that the tools, the capital, and the hedging strategies are all aligning to solve the scarcity problem over the next 24 to 36 months. So where does this leave us? Does this change our core investment thesis? No, it doesn't. but it does change the conversation that we need to have together on this community. Because if you're looking for a stock to double in the next 2 weeks, the easy gains are probably gone. They're not going to double the next 2 weeks. But if you're looking for a structural leader with protected cash flows, historic pricing power, and a massive valuation cushion, this consolidation phase is incredibly healthy. Wall Street may be right, and new supply will eventually cool down pricing. Or maybe Wall Street is early, and the sheer volume of AI models being traded will consume every single gigabyte of DRAM we can print for the next 5 years. But as a long-term investor, we don't need absolute certainty to make money. We just need to understand the cycle. Every great commodity supercycle ends the same way. First comes scarcity, then comes extraordinary profitability, then comes the race to build more supply. The market isn't debating whether demand exists anymore. It's debating how long scarcity lasts. That's a very different conversation than we were having 6 months ago. And if you're going to invest in the memory sector over the next 3 years, that's the conversation that matters, in my opinion. Personally, I'm holding my core positions in the memory sector. I'm holding my core positions in Micron, SanDisk, as well as Western Digital. I'm going to let the noise settle, and I'm going to watch the institutional accumulation. I'm going to watch those levels very closely. But I want to hear from you. How are you navigating this transition? How are you navigating what we are seeing in the memory sector right now? Let me know in your comments below. And my advice would be to keep your head cool, try to ignore the noise, keep your eye on the institutional flow and the signals that we see in the market, stay disciplined, and I'll see you guys in my next video. Have a great night.